Welcome to our first ever virtual credit update. I'm Terry Winder, Group Treasurer for CBA. We are launching this video instead of our usual travel plans. I hope you're all keeping safe in this environment, and I wish we could be catching up in person. You'll have seen that we just announced our FY20 results. You can find these details on the Investor Centre of our website, including a video message from our CEO. Our underlying business performance has been strong, despite the challenges of low interest rates and the impact of COVID-19 on our customers. The retail bank has continued to deliver above-system growth in home lending and deposits. This reflects the ongoing focus we've had on operational excellence. We've divested most of our wealth management businesses now in line with our Simpler Better Bank strategy. And we've maintained our leadership in digital, being ranked again as the best digital bank in Australia. We've announced a final dividend of 98 cents per share, reflecting APRA's recently updated guidance on retaining at least 50% of earnings. One of the real highlights of this result was definitely the strength of our balance sheet. We've ended the year with a strong capital surplus position, and we've got significant excess liquidity. So we're very well prepared for a range of economic scenarios, and we're able to support our customers through this crisis. To date, we've actually been the largest lender under the government's coronavirus SME guarantee scheme. One of the things that's worked very well in Australia this year has been the proactive and coordinated response by government, regulators and the Australian banks to support the economy through the pandemic. We'll touch on that throughout this video, plus over the next 10 minutes or so, the team and I will give you more of an update on our strong capital position, also an update on our excess liquidity and resilient balance sheet settings. We'll summarise our funding activities from the last financial year, which were lower than we initially expected, as well as our projected funding requirements for FY21, which will be lower again. And finally, we'll talk through our credit exposures, which are being monitored closely given the COVID-19 situation. The earnings outlook obviously remains challenging, given low rates and low credit growth. And the COVID-19 situation creates a lot of uncertainty. For example, just this month, our second largest state, Victoria, entered a second lockdown period. We know that unemployment will remain elevated for some time as we're operating with spare capacity. House prices have held up well so far, and there is still support from low borrowing costs. Over the next few months, we expect some tapering of government support measures. While our focus now is to check in with customers on deferred loans and work through the financial support they need to get through the current crisis, we're still positive on the long-term prospects for the Australian economy. I mentioned that the strength of our balance sheet was a key feature of this result, and it means we're well placed for the current context. Our reported CET1 ratio was 11.6% at year end, or just over 12% on a pro forma basis after accounting for the expected uplift from divestments. This capital ratio incorporates the payment of our interim dividend and the negative impact of additional COVID-19 provision. Our ratio translates to 17.4% on an internationally comparable basis, and it makes CBA one of the best capitalised banks in the world.
My name is Kylie Robb, and I'm Head of Funding and Liquidity. I'd like to talk about the fiscal and monetary support in Australia in response to COVID-19, because this sets the scene for our strong funding position. The government is providing over $180 billion of economic support. This is in the form of employment payments, welfare supplements, and other business cash flow boosts. The government entered the crisis with very low levels of debt, and all three major credit rating agencies have reaffirmed Australia's AAA credit rating. Government net debt is projected to rise to about 36% of GDP by June 2021, which remains very low compared to other countries. The fiscal stimulus has been very successful in getting money into our customers' bank accounts quickly. Combined with the option to early access superannuation and the fact that consumers spend less during lockdown, we've seen a surge in household savings. The government has also provided over $150 billion of balance sheet support for banks. This includes the Reserve Bank's 3-year Term Funding Facility, or TFF, to support low-cost lending for customers. CBA's initial TFF allowance is $19 billion at 25 basis points, and this can be drawn down until September 2020. There is an additional allowance which will depend on business loan growth. So, turning to our strong balance sheet settings, we've continued to increase the proportion of funding from customer deposits. This now stands at 74% and compares to 55% at the time of the financial crisis. We've maintained our strength in deposits relative to peers, having the highest absolute and percentage level of household deposits in Australia. We ended the year with significant excess liquidity, with a liquidity coverage ratio and net stable funding ratio both well above regulatory minimums. Our funding mix has continued to skew towards long-term wholesale funding. Our portfolio WAM of 5.3 years has been increasing since the financial crisis as we've deliberately worked to reduce our refinancing risk. Given this excess liquidity position, we've reduced short-term funding from around $100 billion historically to below $70 billion currently, and we expect it to decline further in FY21. We'll remain focused on maintaining these strong balance sheet metrics to ensure we are prepared for a range of macroeconomic outcomes.
Hi, I'm Fergus Blackstock and I'm Head of Term Funding. We issued $14.5 billion of new funding during the period versus maturities of $31 billion. Our issuance has been falling for a number of years now as our balance sheet growth has been increasingly funded by high-quality deposits and credit growth has generally slowed. Our issuance this year included a number of benchmark transactions across our core products and markets, and we also drew down $1.5 billion on the term funding facility. We issued a benchmark $2.5 billion Tier 2 transaction in the US market, where our objective was to achieve duration and make a strong start working towards our 2024 TLAC compliance task. We issued an Aussie dollar 1.65 billion additional Tier 1 instrument in the Australian market to meet retail demand. We issued Australia's first AONIA-linked RMBS transaction, which we were particularly proud of as Australia's largest RMBS issuer. We issued a 5-year SONIA covered bond in sterling, which was our first benchmark SONIA-linked transaction. In February, we published our updated Green, Social and Sustainability Funding Framework, and in August, we released our annual impact report. Our current debt portfolio mix remains balanced in terms of currency. Our portfolio also remains well diversified by product, with senior unsecured debt our largest funding product, followed by covered bonds, where we have historically looked to maintain around 50% of our capacity limit. Now I'd like to turn to our projected funding plans for FY21. As always, these are subject to loan growth relative to deposit growth. We have $21 billion of debt maturities during the year, but as noted, we've started the year with excess liquidity. We intend to make good use of the RBA's term funding facility, which means that there will be a significant wholesale funding substitution for CBA in FY21, from capital markets to the RBA's TFF. So, with a lower requirement for funding, our main focus will be on regulatory capital, namely APRA's TLAC requirement to increase Tier 2 capital to 5% by the 1st of January 2024. This compares to our existing Tier 2 capital of 3.6%. APRA hasn't changed the quantum, nor the implementation date for TLAC as a result of COVID-19. We aim to build towards this regulatory task over time, ensuring we take into consideration prevailing market conditions. We think 4 to 5 billion Australian dollars of annual issuance of Tier 2 is likely. We'll consider a range of currencies and tenors in Tier 2 to optimise our maturity profile, our cost and investor participation. We remain open to reverse inquiries from time to time when we're clean from a disclosure perspective and reflecting a lower overall funding requirement. We've seen good interest in Tier 2 private placements this calendar year already. We'll also likely continue meeting domestic retail market demand for our AT1 product, as this gives our investors the opportunity to roll over their money. While we keep developing alternative benchmark capabilities and would like to build on our inaugural AONIA RMBS transaction last year, we've got no immediate plans for a new medallion deal outside of the scheduled refinancings. So, with a very strong funding and liquidity position, we understand that we may be unable to satisfy all the investor demand, and our footprint in outstanding senior paper especially will reduce in the short to medium term. We prefer to be transparent with our investors about this.
After incorporating the COVID-19 provision of $1.5 billion that we took in the third quarter, our loan loss rate now sits at 33 basis points of average gross loans and acceptances. This COVID-19 provision is a forward-looking adjustment, and it was determined based on a range of plausible economic and industry sector stress factors. It also takes into account the mitigating impacts of generous government and industry assistance packages and support. Our provision falls between our central and downside scenarios. Our provision coverage is now 1.7% of credit risk-weighted assets. It has increased year on year and also compares favourably to our peers. Consumer arrears remain low, although these are insulated by the loan repayment deferral packages. Credit card arrears are showing some signs of stress, but around half of the increase seen in the fourth quarter reflects lower balances overall. At the end of July 2020, 8% of our home loan customers and 15% of our business customers were on loan repayment deferrals. This is down from 30 June. We're working with these customers to return to normal repayment arrangements as soon as possible. The majority of our deferral customers are in lower risk segments. Some have continued making repayments. Some have a buffer on their repayment schedule, are in stable occupations or have low LVRs. We're leveraging our digital platforms to conduct regular and continuous check-ins with our deferral customers. We've more than doubled our financial assistance solutions team to 1,500 staff, and this enables us to have direct conversations with our retail customers who are experiencing hardship. We're using machine learning technology to identify customers in hardship so we can prioritise support and make contact where it's most needed. More than 50% of our business customers on deferral are relationship managed, and this supports our ongoing contact strategy. And 89% of the loans are secured. As usual, we've provided a summary of our credit exposures by sector, and with more sectors of interest this time shown in the grey shading. We've undertaken bottom-up, granular assessment of likely stress at the customer, industry and sector level, and our focus is on at-risk industries and geographies. Some sectors will take longer to recover than others. Early impacts are predominantly in larger institutional exposures, and these have driven our troublesome and impaired assets up to $8.7 billion. Sectors most exposed to COVID-19 include culture and recreation, transport, manufacturing and retail. To date, consumer and SME portfolios have had the benefit of loan repayment deferrals and government and industry assistance packages. So we'll continue to monitor our credit exposures closely and ensure we have the appropriate level of provision cover in place. My name is Lindy Newton and I manage Debt Investor Relations. We wish we could be seeing you in person this year. We do get a lot out of our meetings and we're keen to invest in our relationships. But I hope you found the virtual credit update useful and we're keen to hear any feedback. If you'd like to catch up with any members of the Treasury team or ask any specific questions that we haven't addressed, please feel free to reach out.